Okay, there was a quick video that I wanted to make discussing much of the economic situation in the United States right now. And it's, okay, not just the United States, but the world too, considering how the entire world is suffering from inflation right now, and that, the saying that if America sneezes, the rest of the world gets a cold. Or maybe that's just Canada, whatever. Okay, so there's a great deal of upheaval in the market right now because of inflation, and that's making a lot of people nervous. That's raising prices for regular everyday people. Now they can't fit their budgets, so they have to go out and borrow more money in order to cover their expenses, and that includes businesses and regular people as well. So essentially the money supply is expanding because people can't afford shit, and then they're going out and borrowing money in order to cover their bills. Okay, now on June 15th, the Fed raised the interest rates by 75 basis points. That is the biggest short-term raise since 1994. Like, seriously, since like the Clinton era, and that was before. That was right after NAFTA. Now, the Fed's put out a lot of positive messages. The Treasury have said, everything's okay. We're going to get things under control. It's going to be good. But really, they're just sugarcoating a bad situation. That's not to say there's some massive cataclysm coming. It's just worse than they're portraying it to be, which they always try to make it seem better than it actually is in order to boost confidence in markets, because markets aren't rational. And that's a virtue somehow. Ask people who support capitalism. But essentially, everybody's lost control. All the central banks across pretty much every single country has lost control of the situation, and inflation is continuing to hammer everybody. They're kind of in a situation where they don't really know what to do about it. And that's kind of what makes it worse. Nobody's really taking the lead on this, because a lot of these central banks and these experts, PhD level economists, don't know what to do, because the traditional Keynesian model, isn't really working this time, and that's a problem. And we've had so many things. We had supply issues. We had that stupid evergreen ship getting stuck. We had the lockdowns from COVID. We had panicked buying, then inflation. Many stores are now in the U.S., you can just Google it quickly, are saying anything you want to return, they're thinking of like paying people to keep stuff that they're trying to return because their inventories are messed up. So a lot of them saying that their inventories are full. This, I think, primarily came from Target. I'm not sure. Okay, so the main problem here that's freaking people out is the yield in government bonds. Okay, so what's a government bond and how does it work? Okay, government bond yields rose sharply, and this is good or bad depending on which side, whether you're buying bonds or selling bonds. Okay, there's the yield. It's the coupon amount or price. When the price changes, so does the yield. Okay, you go and you buy a bond for $1,000 with a 10% coupon. So at this point, it's simple. You hold on to it. The issuer pays you $100 a year for 10 years. Then he pays you back $1,000 on the scheduled date. The yield is therefore 10%, 100 or 1,000. If you decide to sell it on the market, which you can do before the time is up, you won't get the $1,000 because bond prices change on a daily basis of prevailing interest rates. If the price of the bond in the market is $800, it's selling under face value or at a discount. If the price of the bond market is $1,200, it's selling above face value or at a premium. Here's the main point of confusion. How can high yields and high prices be both good when they can't happen at the same time? Okay, normally that would seem counterintuitive, but there is an explanation, and I'm sorry, this really is confusing. It is hard to understand. The answer depends on your point of view, as I said earlier. If you're a bond buyer, you want high yields because you're going to make more money. If a buyer wants to pay $800 for a $1,000 bond, which gives you a bond yield of 12.5%, on the other hand, if you already own a bond and you're locked into your interest rate, so you hope to see the bond go up, the price of the bond go up. This way, you can cash out by selling your bond in the future. I know. Google how bond yields work. You're going to need to. This is pretty confusing. Basically, what they're saying right now is that there's a lack of trust in the government's economic health or ability to plan for the future. So there's a good deal of people just trying to get rid of bonds because of the inflation. They're freaking out. They don't think it's good. It's all a matter of opinion. Because, again, the currents go both ways. When someone's panicking, someone's saving. When someone is hoarding, someone's spending. It all depends on your perspective and which angle that is that you're coming at the economy from. So the main problem is that the S&P 500, which is one of the main stock markets in the United States, went down to 20%, or what's called bear levels, which meaning it's instigating what's called a bear market, where people are holding on to their money and not running out and investing because they're unsure about the future, and inflation is making things difficult. On the other end of that, you have the DXY. Now, it's an index of the US dollar compared to half a dozen other advanced currencies. Advanced meaning from the rich countries, which is up about 10%. So the value of the US dollar against other currencies, those primary ones from the rich countries, it's up 10%. But at the same time, the Japanese yen, which is very interesting because usually the two are relatively linked together because Japan is such a huge trading partner with the United States, is at a 24-year low. Their currency is dropping in value like crazy. So the Fed is restricting policy to control inflation, whereas the Central Bank of Japan is buying bonds in order to raise it. So you have like the two opposite ends within the same global economy trying to deal with opposite problems at the same time. And that's the gist of what's going on right now with inflation. And that makes things it's all a very complicated tapestry of how all these things work with each other. But this is like the most bare bones, simple way that I can explain it. And that tends to be, like, honestly, the best I can do. The Fed raised, like I said, the benchmark interest rate by 75 basis points. Australia raised it by 50 basis points, and the European Central Bank raised the benchmark interest rates by 25 basis points, meaning they're making it more expensive to go out and borrow money, making it more difficult to expand the money supply through loans. So when you don't have enough money, they're making it more expensive to get more money that, depending on your economic situation, you need. I know this it sounds very confusing and counterintuitive, but that's the situation that it's in right now. And honestly, this is the easiest way for me to explain it. I mean, it gets more complicated. Maybe somebody better educated than me would have an easier time doing so. But honestly, that's the best I can do. So hopefully you did learn something from this video.
Thank you for watching. If you like this program, then please head over to my Patreon page and set up a monthly donation. It's your donations that keep this program running. Also, if you would like, please rate, comment, subscribe, and share in various social media.